You're listening to the Build to Rent podcast. Build to Rent podcast.
Welcome to the Build to Rent show. Steve Olson here, along with Chase Levitt and Sherida Zanger, who we're happy to have back. Welcome back.
Thank you.
Chase and I, we gabbed a lot over the last few weeks and covered some good stuff, but we have more Build to Rent information for you today. Make sure you subscribe on iTunes, Spotify, or wherever you get your podcasts. That's the smoothest one of those I've ever pulled off. Yeah, all right. Okay. We're sitting here late January 2023. Chase and I were kind of talking about this the other day, but it's funny. There was that time mid 22 through the end of the year that was just weird. We talked a lot about price discovery on the show. We've turned into 2023, and not that everything is all peachy, but it seems like people are wanting to get going with business again a little bit. Is that the vibe you're getting? Like when you talk to investors, and what are you seeing?
Yeah, I feel like people were kind of hanging tight, didn't know what to do at the end of 2022, or that fourth quarter, I guess is probably what we should say. And I feel like rates have come down a little bit, and so people are feeling a little more comfortable to kind of come out from under their shell, like they were just kind of hiding for a little bit or hibernating.
Yeah.
And like I know, for example, I had put a resale up for sale in Harriman here in Utah, and I had 3 cash offers on the property. So I think there's a lot of cash buyers out there as far as investors go, and I think there are some investors that are out there that are still willing to finance, even if it's a little bit cash flow negative and they know possibly they could refinance, or they have the possibility of maybe increasing rents. But I think people are starting to realize they have to do something, and they sat around for a little while, and now it's time to get back in the game, or at least put their toe in the game.
Yeah, and I would agree. I've had a couple deals, whether they're finished, off-market deals or on the MLS, so completed, multifamily, where it seems like those are starting to move if they're priced correctly and they cash flow a little bit. And then we're doing the new construction stuff, and we're starting to fizzle out towards the end of our projects with stuff that's been moving for us. A couple hanging around a little bit, but it seems like we're getting some reservations there.
Yeah, investors are more interested now. Now, I think, does it feel like ultimately what it's taken to get to this point, and I'm not saying that this is the point where there's been a price discovery or where we know what the cap rate is, but it feels like so far there's been a 15 to 20% pullback in what an investor would pay in early 2022 versus what a few of them, because it's not like the water's boiling.
No,
here.
it's not. Everyone's not jumping in at once, right? We have a few people.
A few are interested in the price now that it's come off that amount. I would say that's like a 1% cap rate swing. Ish.
Maybe a little more than that.
A little more? Okay.
Yeah, it might be a little more than that.
So 1 to 1.5 points in cap rate swing, and 15 to 20% reduction in price. Like we've had some deals that we're talking about fourplexes here. It doesn't translate directly to entire communities. If anything, entire communities are more dependent on the cap rate. But stuff that could sell for $1.4 million, now you're kind of
maybe 1.2,
yeah,
or 1.1, maybe a little lower. Depends on the location.
Seems like a little bit of going back and forth
rents are.
in there.
Depends on the location and the rents.
Yeah. Well, and we need to talk about rents and maybe on our next episode. Okay. Well, that's interesting. I had read some info from an associate of mine that went to a multifamily development conference. I can't remember which one. And it was just in the last couple of weeks. But the big consensus with the institutions was they like fundamentals. They've been waiting for some better deals. If they get a lower cost of capital, there's a ton of capital ready. That still remains true. I want to tell the listeners that in the calls I do, there is capital out there. So that capital is waiting for a little bit better rates. But many of these institutions said, we're kind of watching, and if it drags out a lot longer, we've just got to deploy our capital.
So do you think that people were also possibly waiting to see, they didn't want to buy something at the high of interest rates, even though they know they can refinance? But I know that there's, you have to wait a period of time before you can refinance. It's not like you can refinance in 30 days. But do you think some people were like, I don't want to be the fool that buys at the very top of an interest rate because they don't want to have to pay the fees associated with refinancing? And so people were maybe wondering and waiting for it to trickle down a little bit? Because I feel like it's kind of been up and down, and now it's come down a little bit. It's nowhere near what it was, and it won't be like that. But do you feel like maybe some people were not wanting to be the sucker for the highest interest rate?
Many of them told me that for a fact. Yeah. What do you think, Chase?
That could be part of it. I think what we talked about in previous episodes is cash flow. So if the price came down a little bit, or if the interest rate came down, depending on what the rents are, if it cash flows or breaks even, they just don't want to be in the negative. And that's what we were seeing end of 2022, right?
Yeah.
Negative cash flow on a lot of properties with what they were selling for and with where interest rates went.
It's that cost of capital problem. I mean, it was so fast. I mean, I can't cite the articles, but I could have sworn I've read that it's been the fastest increase in interest rates that we've ever seen.
It almost felt like the COVID switch, where it was all of a sudden COVID happens and everyone just paused and didn't know what to do. And I felt like that's what it was with interest rates. And they just kept going up. Like everyone was like, okay, they can't go up again. And they just kept going up. And so I think everyone froze.
And there seems to be kind of in the air this feeling that, yeah, they might kind of go up for a little while longer. Not a ton. I mean, when the Fed increased by 0.25% versus a half, it's kind of like that it's cresting to a degree, and some people are. It's just so funny, the market.
Yeah.
It's got a billion variables. We can never count them all, but somehow it all eventually just kind of settles and it becomes the market.
But that's the question. You talk about the COVID switch. What was that? Let's say a 2 to 3 month period.
I think it was only 2 months.
Yeah,
personally.
it was like
where people put the brakes on.
Yeah,
and they stopped buying. But we still had some projects that ended up being really good opportunities.
Payson and Provo.
And what other opportunities were out there nationwide? And so are we now in that opportunity phase to where we need to start looking? I know a lot of people are thinking that, but then a lot of people are saying, no, let's let it come down more. So I don't know. I'm curious to see what happens in the next 3 to 6 months is what I'm saying.
Don't we wish we had a crystal ball?
Well, a couple months ago, there was nobody on the it's an okay time to buy bus. Now there's a few people on it. That bus has a lot of seats left still, but there's some people on it. Yeah. So, I mean, this is going to be interesting. It's going to be interesting.
Well, I feel like it's a little give and take on both ends too, right? Because buyers thinking, hey, I kind of have a seller, a noose around their neck in a sense, because if they want to sell, I'm going to offer them whatever I want. There still is a little bit of negotiation on both sides, but
it's like we've been saying, you're not going to get rates to come all the way down to meet where they need to be, but you're not going to get rents to come all the way up. There's going to be, we have to have some give back on price. We have to have some backtracking on rates, most likely before we see, if you want to call it equilibrium, whatever that means right now.
Well, I feel like we've pulled back on price quite a bit on resales is what I'm speaking specifically to, with a little bit of movement in rate, but there comes a bottom line for some of these sellers where they still feel like, hey, I need to make a little bit of equity off of this property, but I'm.
Well, and I think too, think about what you own right now. And by the way, we have not even touched on what we were going to talk about on this episode yet. But we own fourplexes in here. We've got some other projects going too. And the big concern is the people selling right now probably have to sell. If you don't have to sell right now, why would you? You're not going to capture some massive profit. If you've got fixed rate debt, I've seen the attitude with all of our clients be, I'm fine. I'll just, whatever's going on right now, I don't know, but I'm not selling. And they bought at enough of a discount. They have a fixed rate that even some of this rent pullback that we've seen, and it is real, they're still fine. But what if you have variable debt? What if you have debt coming due? And I've heard a lot of people talk about, many of these big developers that went in heavy when COVID started that are now nearing the end of construction. They've got adjustable rate debt. They've got bridge debt that now has to be paid off and roll over to permanent financing. And the big issue there is that debt that you thought you were going to get before with a low interest rate, you don't have it anymore. And for the listeners, you've got to hit a certain debt coverage ratio on those loans. You're going to have to bring in a lot more capital. Now, here's the weird thing. The capital does exist, but it's expensive. It's choosy, right?
Might be more painful.
If you're raising equity right now, it's there, but it's going to cost you, right? So it'll be interesting to see how that filters through. How many people just say, I got to get out of this thing, or versus, well, we're going to go raise some equity and we're giving away a whole bunch of our profit to hang on.
Yeah.
Okay. Well, let's look at this. I like housingwire.com. Good website. They are not a sponsor of the show, but after that comment, they should be. Come on, HousingWire. Article that was published back on January 9th called Build for Rent is a Bet on the New Normal Housing Market. And I would say, tell me if you think I'm wrong, the new normal means a market where inflation has been stubbornly high, is backing off in some areas, but not in others. And you know what? I'm just going to kind of throw in with inflation, lack of availability, even though that's not directly tied to I pay more. If you can't get the product, in a way that inflates because it's more time with the debt clock ticking. And
I think there's a lot of builders sitting out there that have inventory. There's a lot of inventory that's ready to come to market, but we're still having supply chain issues, right?
Yeah.
I mean, our project in Arizona is the perfect example of that, where we're still waiting on electrical panels. And so I think it'll be interesting when we do have more inventory hitting the market.
Last week we were in Arizona and viewing one of our projects there, and there are a couple of buildings, probably 60 or 70 units, all in all, that I think are inside. They just need a final cleaning. Appliances are in there. But when you go out to the side of the building, a whole bunch of big cables and wires coming out of the ground with nothing to connect to. We need those electrical panels. A good quote from this. Now, this is, like I said, this was published a couple of weeks ago. They're using data retroactively, but I think it's useful. Developers are forecast to start 74,000 build-for-rent units in 2022. I wonder what they really started. We'll see. Up from 59,000 in 2021. And this is coming from a report by Northmark. And so that's 33 billion in annual transaction volume and loan servicing of more than 76 billion. So the pace of units was going to be up 21% compared to what it was in 2021. What do you think about that? What I'm confused about is I was always thinking interest rates go up, so do rents. It creates more renters. And we've discussed this on the show a little. It doesn't feel like that has happened really much over the last 6 months. Do you think it's because of the increase in inventory? What are your thoughts?
I don't know if it's the increase in inventory or if some people are just a little bit scared and they can move back home with mom and dad, or they have some kind of another option to save money because nobody knew or knows how long all of this is going to last. So I wonder if some of it could just be there's existing inventory, right? Not necessarily more new inventory, but existing inventory because people are looking at other options.
Right.
I don't know. Chase?
Yeah, I don't know. I'd be curious to see. I wish they had the data for 2023 on what they're forecasting. That'd be interesting to see. As far as build for rent.
Oh, I bet you the planned build for rent is way down. I mean, it's this article talks about, and this is Lennar. Lennar starts trying to sell big blocks or tranches, as they call it, of single family homes to investors. And we saw that. I got offered a whole bunch of townhomes here in Utah by a builder in Utah. Another one came and said, we've got all these homes. We've got a great investor special, but it wasn't good.
But these were single family homes.
Yeah.
These are single family townhomes, right? That now they're pivoting over and saying, hey, these can be built for rent, Which is funny because investors were buying a lot of this product anyway, and now it's all of a sudden going to be built for rent, but it still is single family product type.
But they would say a unit, talk about a townhome unit, right? Where the retail market at its peak, probably I would say was 1 year ago, maybe give it a couple of months beyond that. The retail market, that 1,500 square foot townhome here in Utah, you could say was worth $425 to $450. Do you agree?
Maybe even a little high. Well, 1,500 square feet. Yeah. If you're going a little bit bigger, it was more. But yes, 1,500 square feet, you're probably $425.
Okay. 425-ish. And they came to, and by the way, we've been selling townhomes in Utah, pre-construction, fourplex platted townhomes for like $278 a unit in our latest deal in Ogden, Utah. And these guys were coming to me and we were squeaking. We were squeaking to get to, I think it was $390 a door.
I was going to say, you were right under 400, I remember.
Yeah. And there is an advantage when you model that out financially, which is you can just close as they're delivered. What kind of deposit are they going to require? But still, it just wasn't even close. We're doing this. This is an investor special. Well, you can't take a retail designed community and then later say we're going to make it a build for rent. You're going to lose cash on that deal. And I think since then, a lot of these have done this give and take of, well, let's bring our price down. Let's buy a retail owner's mortgage down on the rate. And those two have kind of slowly grown together to where, are they moving townhomes now here?
I feel like, who did I talk to yesterday or the day before? But somebody said that they had heard that, I think it was JT, I think it was one of our lenders, I think it was JT, that had said that they're contracting on quite a few properties now, single family type of properties. So I think that buyer is even starting to come out. So I would think they're moving some of that because a lot of these people probably realize I have to get a home at some point. And again, I don't think they wanted to pay at the high.
And they don't feel like they're doing that anymore.
No.
Yeah, more people on the bus.
They feel like, hey, these builders, they were in hog heaven there for a while, and now they've had to come back down to reality. So maybe some people feel a little more comfortable with that right now.
Yeah. So I'm curious because remember our trip in Arizona? We went to Arizona. What was it, last week?
Yeah.
2 weeks ago. Last week. Took the team down there, and it was a good visit. And one of the things that stood out to me, we met with someone that was pretty well versed in land and what's going on. And I just remember he pulled up like a parcel map or some corner, 1 mile radius. And because we're looking at a couple different sites down there, and I thought it was amazing how he just started clicking on an intersection, and around that intersection in Phoenix, Arizona, he started clicking like numerous projects that were either happening or that were going to start happening in the next 1 to 2 years.
I don't want to name the intersection.
Yeah, and a lot of that was
dirt. Yeah.
Now, my question for you guys: do you recall, was that a lot built for rent, or was
no?
it
That was
both?
Class A apartments predominantly. There may have been one build for rent from like a villa or one of these Phoenix build for rent communities, but a lot of that is Class A.
Yeah. So I guess is where I'm going with this, and this article is part of it says knowing where to build.
Yeah.
Let's talk about that for a little bit.
Yeah.
Knowing where to build. Don't we all wish we knew that, right? Because that little corner, when you start to see all those little projects popping up, I think it's important to understand, okay, what are you building? And if it's built for rent, are you going to be competing with the Class A? Do you go put in another Class A apartment? Are you doing fourplexes like us, townhome style? Are you doing single family for rent? And one of the things that he brought to our attention is there's a lot of single family for rent communities down there, like the Christopher Todds. I think there was a lot of builders that saw that and they're like, or developers, investors, like, man, I want one of those. And I think it's a pretty cool model, right? But it seems like there's a lot of that going on in that area.
Yeah.
Not to say it's a bad model, but Phoenix also is so huge, right? It's a huge market. So I think it's important to understand that market specifically and get pretty, macro with it or micro. Zone in on specific areas, knowing what's there, what's needed. So let's talk about that for a little bit. Knowing where to build. How do you know where to build?
I think we've been good at that. I think it kind of goes back to our funny little saying that we say, go buy a Chick-fil-A and a Costco.
Yeah.
But I also think we're different in knowing where to build because it's also knowing what to build in the area. So if you find a good area, like you guys were just saying, a lot of that was Class A stuff. We're not Class A. We're Class B, maybe C+ at times. And the other thing that I thought was interesting was the rents, because he had said, and two different people that we met with down there had said that the Class A apartments were seeing the bigger hit in the rents, where we had looked at some of our pro formas that we had projected on a couple of the projects down there, and we're still going to have higher rents in those projects because rents have increased in the area. But I think it's that higher end stuff that's taken the biggest hit as far as rent. So if you are banking on getting $2,900, $2,700 in rent, and you end up with $2,500, that's going to kill a lot of these deals.
Yeah.
Where ours, it's not, right? We're right around that $2,000, $2,100, I think, for one of our projects.
Yeah.
Let me read this real quick if you guys
Go
don't
ahead.
mind. It's under the knowing where to build. It's Ben Hunsaker. I obviously haven't met him, but I think he has a good little point here. He's a portfolio manager for Beach Point Capital Management. And if you go down just a little bit here, I thought this was interesting. So he said the build for rent market, BFR, is becoming much more of a game of geographic chess. Adding that there are great places for build for rent, and there are awful places for build for rent. This is what we're talking about here, right? He points to Florida, a long-time hot single-family rent market, along with the southern Sunbelt states generally, as an area where there are now many not-so-good places to pursue BFR communities. So I thought that was interesting. We haven't been in Florida. We're just talking about, should we get in Florida? And I still think there's opportunities down there. But I also think it's important to do your homework and understand where to go and what product you're putting in, like you talked about.
Yeah.
Well, what does Florida mean, right? It's a big state.
Exactly, yeah.
Big metros and the whole South. To just write it off with all the population growth that it's experiencing. I had a really interesting conversation with a family office out of LA yesterday that is building and developing in some of the same areas that we are, especially in South Phoenix. And he had a good observation because they're going through some lease up on some build for rent right now that people, they say, hey, this is a tough time to do that. It's not impossible. It could be better, but it could be a lot worse. And I think when we talk about where to build, it's so much about what to build as well.
Yeah.
Mm-hmm.
You can't talk about one of those without the other. And he was telling me about a build for rent townhome project that they did in Chandler, Arizona. And I believe he was hoping to get $2,300 a month a door. And this was at peak COVID psychotic leasing fever.
And what style are we talking? Are we talking
Townhouse.
townhome? Okay.
Yeah. Nicer, but no crazy amenities or anything. It was a smaller project. And they were hoping 23, 24, and they got 3,000. Crazy. And then 18 months later, some evictions, some payment issues. Their rents have now started to settle down into the 2,600 range. So they got some gains, but they had to backtrack from the crazy high price. So he made this good observation when he was talking about another project that they're leasing right now. They're 2 bedrooms in South Phoenix. They're getting 1,700, no problem. They fill those things over and over and over again like crazy. They're 3-bedroom townhomes. He's thinking he's going to have to settle at 23, 24. And that's a much slower trajectory. They are getting them. But here's the long-winded summary of his observation. In that submarket of South Mountain, there are only so many people that can afford $2,500 up in rent, right? There's a lot of people that can afford the high ones and even edging into the low 2s. So how big of a tenant pool do you want to draw from? You're in the market. What other supply is there? But what can people really afford? I think it's so important to study the area's median income and know that, 30 to 35% of that is generally a healthy level for rents. And how many people fit that bill for what I'm trying to get?
Well, and maybe household formation, right?
Mm-hmm.
How many people typically are in a family living in that area? Is that 4 or 5 people? Well, then you're probably going to need stuff that's more geared more towards 3 bedrooms. Is it 2 or 3 people? Then maybe you could get away with having more 2 bedrooms. I think if you have a mix of product type, that's always helpful. That always doesn't happen. But we have a project down there that has some 2 bedrooms and some 1 bedrooms. We have another project that's all 3 bedrooms, right? So I think knowing who you're targeting is helpful as well.
Yeah,
along the same lines. Yeah.
The rent is what somebody will pay, and somebody will pay only what they can pay. And the discussion with this guy was we were both really liking townhome product there because you drive through Phoenix and you see a lot of multifamily A-class construction, and then the build for rent fully detached, and the rent on that stuff is really, really high. They're targeting A-class tenants. Are you targeting A-class tenants in a B or C-class neighborhood? That's really what this comes down to. You have to have that rent level that takes care of that.
Yeah.
Well, okay. Anybody else have anything to say?
No, I think that's some good information.
Yeah.
Definitely.
Yeah, we hope the listeners find it useful. It's not always well organized, but it's real. It's what we're getting on the street right now. So thanks, everybody, for listening to the Build to Rent show. We'll catch you on the next episode.
Thanks for listening to the Build to Rent podcast. You are now just a few clicks away from joining our community of Build to Rent investors. All you have to do is follow our show on Facebook, LinkedIn, or wherever you're listening to this podcast. You can also watch this episode and more by subscribing to the Build to Rent podcast on YouTube. The information presented in this podcast is general in nature. Nothing in this presentation should be construed as financial advice or recommendations for any particular situation. The hosts are only licensed to provide advice and services in the states where they are specifically licensed, and listeners should seek the advice from an appropriately licensed professional in the area where they invest. The examples presented in this presentation are for illustration only, and no guarantee that similar results can be achieved, since the facts, circumstances, and participants are all different.